Welcome, everyone. On behalf of Cambridge Healthtech Institute Global Web Symposia Series and our sponsor, Enrich, I'd like to welcome you to Methods, Metrics, and Effective Meetings, Best Practices in Portfolio Management. My name is Elizabeth Lamb, and I'll be the host and the moderator for today's event. I'd like to introduce our presenter for today. He is Dr. Richard Sonnenblick, PhD, CEO of Enrich. Welcome, Dr. Sonnenblick. The presenter ball is yours.
Thank you so much, Elizabeth. Really appreciate the opportunity to speak with all of you today. We're going to be talking about making the most of every R&D resource through effective portfolio management. So with a suite of software tools, Enrich helps companies make the most of every R&D dollar. And I'm really proud to say that today tens of billions of dollars of R&D funds are shaped, allocated, and monitored with Enrich Analytics. The topics I'm going to cover today are lessons learned through over 15 years of deploying our portfolio management solutions and processes with our clients in life sciences, medical devices, and other R&D-driven industries. So we do what we do at Enrich because we stand for transparency. We know that often the most worthy projects do not get funded. Rather, it's the projects with the most persuasive or passionate sponsors or politically savvy sponsors, or maybe just outright bullying sponsors. And what we're trying to do at Enrich is deliver tools to our clients so that collective wisdom of the company, of the entire organization, can be brought to bear on every critical R&D decision. And for us, that's the reason transparency is so important. So our tools don't make decisions, but they should be able to present what's true, what might be true, and provide a framework for the right conversations about the key issues and at the critical time. So what we're going to be talking about today is largely how do we get to those effective conversations. Let's start by looking at the ecosystem and the agents associated with decision-making around research and development. On one hand, you have your data consumers, the executive team and division leadership. Those folks are interested in having the latest information about every asset in the portfolio, every lead and follow-on indication in drug development, and they want that information basically in real time. They want to be able to not only look at the top-line portfolio view, but drill down very quickly into the details of a project and then come back up. That's the job of the portfolio analyst, having that information at their fingertips. And that's really the reason that portfolio analysts that we see in many companies without a system like ours in place are forced to build PowerPoint decks that have dozens, if not hundreds of slides, and then backups to those slides as well, because they're not sure what questions the executive team will ask, but they want to be sure to be able to answer every single one. The challenge, of course, is those decks are going to be out of date the moment they're built. On the other side of the fence, you have the financial analysts, commercial teams, project teams, clinical teams, and all those teams are really what we call data providers. They're providing information that build up the understanding and context, the value, the risk, cost, and opportunity associated with each of the assets in your portfolio. And the trick of the portfolio analyst is to be able to facilitate the free exchange of approved and validated information to the executives without being a bottleneck. So let's look now at the essential activities that this ecosystem takes part in. It begins with building up that valuation or asset model, understanding the value, perhaps in a vacuum, of each of the assets in your portfolio and ensuring that there's a validation capability here so that you're confident, you know exactly where the revenue story came from, where the cost information came from, where the schedule came from, and that it's all up to date and that information can be freely explored. That enables the data consumers to then explore, as I said, from the top line down to the individual projects and back up again, but also to look at prioritizing the projects in the context of the larger portfolio, perhaps with prioritization, perhaps with optimization, if it's a sophisticated enough portfolio with enough options. And then to compare different portfolio level investment strategies. And then finally, none of this is really useful unless there is an opportunity to make decisions, to monitor the wisdom of those decisions, and see in retrospect if something else should be done now, and then revisit. So let's jump into today's agenda. We're starting with project metrics. We're going to talk about prioritization methods. We'll talk about a few risk management views, and then finally end with a section on portfolio reviews. So let's talk about valuation metrics and methods and the purpose of all valuation. Well, when people think about valuing the different assets in their research and development portfolio, they usually think about the fact that you're doing it to characterize project attractiveness. But it's more than that. It's more than just a number or a score. It's also to ensure that the project team and the ecosystem that we looked at a minute ago has a common understanding of what the project is. Not just the value in some numeric form, but also the whole story of the project. And the reason for this is because we're trying to enable effective conversations about this project and all of the other projects in our portfolio to try to understand, is it worth doing in the context of everything else that we have going on right now? So some important considerations to think about when thinking about quantitative valuation. Quantitative models do provide a focal point for conversations, so long as the assessments are comparable. And it's important to remember that when you get started on your journey with a quantitative model, most companies start with something that's actually too detailed, because building the model is easy. The challenge is in populating that model, collecting the data, and collecting quality data. And you can always add much more detail later if the executives, those data consumers, are looking for a more sophisticated valuation approach. Harder to take it out in contrast. So we like to use a litmus test of when additional detail is being considered for a valuation model, will that detail lead to a better decision in the time we have available to make the decision? Because it's no help if the decision needs to be made today and that additional data won't be ready for several months. So let's look at the continuum of metrics. You can start with very simple valuation metrics, such as just the addressable market size for a given population. Or you can look at the market share within that market that you might attain, the product lifetime and the price to get an estimate of revenue. And that could be just a peak revenue estimate, or it could be a 5-year revenue estimate, or perhaps present value those revenues. And then we can look at a series of cash flow related measures or metrics as well. So where do you fall on this continuum? Where should you start, or where should you be on this continuum? There's no right answer. You can think about the goals of the company and understand what metrics might show you progress towards those goals. You can look at the current project phase, the duration, the current period budget, or the total budget to get to launch for this project, and use that as a determination of how sophisticated your valuation should be. The more money on the line and the larger the initiative, the more serious your valuation should be, and a greater attempt to be more precise would be appropriate. You can also think about the complexity of the technologies involved in the uncertainty, both in the technology and the market. But then finally, the most important deciding factor of where you select your place on this metrics continuum is how sophisticated is the decision-making culture at your company? Is it related, or is it accepted to do Monte Carlo simulation, or are you not looking at quantitative cash flow measures at all, for example? And how sophisticated are your decision makers? What are they looking for in terms of support as they look at the value of each opportunity? I'm not going to go through this in detail, but enough to say that comparability across valuations for your assets is critical in best practice portfolio management. And so those factors that should be comparable include time horizons and discount rates, market sizes, staff class loading rates or currency, exchange rates, the cost accounting details and how that works, both for outside, inside, and staffing costs, capital costs versus expenses, post-launch costs, thinking about cannibalization, if you're in an area where you may be cannibalizing your own products as you refresh your product line, and thinking about terminal value. So let's start by talking about a simple revenue story. So this market worksheet is actually a screenshot from one of our tools, and I wanted to bring it up because it tells a story very succinctly in one page about the specific market segments, about the filters for those segments, the story of how revenue is accrued, and the uptake curve that's used here. And you see on the upper right a diagram that underscores the actual market, and then the multiple segments, and then the filters on those to get to the overall share. And then a simple chart of units and revenue. So within this one page, we have the ability to push down and pressure test the segmentation, the filters, the share, and the overall revenue. There's a lot more detail that goes on behind this, but being able to put all of this on one page can remind both the executives and the project team what's important and enable them to present the whole revenue story at once to decision makers. This is, in our tool, interactive as well, so you can explore adding or modifying market segments and get a sense of the sensitivity of the overall model that you've built. Okay, let's look at net present value. It's often used and often maligned, yet it has a lot going for it. It takes total costs and benefits into account, distills the twists and turns of a P&L into a single value, single present value. And looking at NPVs across your portfolio can give a sense of the overall winners and losers, all other things being equal. And you can risk adjust net present value to account for the possibility that you may fail before you actually get to market, or you may even fail commercially within the market. And then finally, NPV is familiar to many, both inside and outside finance. So some of the challenges around using net present value, people say it hides the total cost of each project. You can look at two projects with the same NPV, but they have perhaps a very different investment outlay that's required. That's why we like using a productivity metric, which we'll talk about in a few minutes. NPV doesn't tell the whole story, that's what some people say. We like to employ other value metrics, such as looking at peak revenue or looking at simpler metrics such as market size. And we also employ portfolio balance, as we'll talk about later as well. Now, we do agree the NPV is wrong in that your forecast is always going to be uncertain, and it's appropriate to use scenarios or express inputs as ranges to create a resulting range of NPV outcomes. And we do this to avoid a sense of false precision. And then finally, I have to say that it's not appropriate everywhere. For early stage opportunities or for pure research platforms, you might not want to use an NPV method, and you might not want to compare NPVs, strictly speaking, against your other late-stage assets. We'll talk about that more later as well. So risk-adjusted net present value is often also used. In this case, we'll have an initial phase of development with a cost, and we may successfully transition to the second or future subsequent phases, and eventually get to a set of benefits that we accrue. And so we'll always incur that first cost of phase one, C sub 1, but then C sub 2 and subsequent phases will be incurred only if we successfully finish prior phases. And then the benefits are a function of successfully getting to the benefits portion of our life cycle. So this can be extended, obviously, to multiple phases, and there's no simulation that's going on here, even though we're looking at the probabilities of success by phase. And you can also present value the cost and benefit streams to create a risk-adjusted net present value here. So other cash flow metrics exist. I'm not going to go through these in a lot of detail here, other than to say you can accumulate sales, you can just look at a present value of sales, look at peak sales, or you can look at an annuity corresponding to the NPV. And there are productivity measures as well, where you look at either the internal rate of return or a return ratio, such as a value over cost. So the net present value of all of your revenues over your costs. And then the question, as you see in this slide, is will you divide your costs pre and post launch for the entire lifetime or something in between? A set of quantitative measures involve looking at break even. A lot of our clients ask us if they should be capturing uncertainty. And it's true that every point estimate is wrong, but just because it's wrong, it doesn't mean you should be overwhelming project teams by making every input uncertain and require a range of values or scenarios for it. We like to say avoid pajama valuation. So if the models are so onerous that people are working till 11 or 12 at night the day before the portfolio or project review just to fill out these input templates in their pajamas, you're not going to get good data quality. So there needs to be a culture or process that enables open discussion around each opportunity, and people understand that these valuation activities are more than just perfunctory. They're essential, and the results will be used to really decide whether the project will move forward or not. We see the most important drivers of uncertainty to be success by phase, reimbursement, share, and if you're a price taker and not a price setter, the price. And in this organized and public healthcare-based environment, most of us are actually price takers unless we have something that is greatly superior to the current standard of care. So capturing uncertainty. Only biostatisticians, petroleum engineers, and so on think about normal or log normal distributions. For the rest of us, it's good to think about discrete events such as the probability of moving into the next phase, or for continuous events, maybe a low, a medium, and a high estimate, and assigning probabilities to each of these estimates, or simply assuming the low only occurs, or something less than the low only occurs 10% of the time, something greater than the high only occurs 90% of the time, and you can interpolate a distribution from this. Whatever methods you're using, it's important to use sensitivity analysis to continually pressure test the impact of your inputs for an asset's range on key outputs. So what are these sensitive inputs that affect, to a point that would change our decision, the value or another metric of merit for a given project? And use this to then determine which of the inputs need to be expressed with uncertainty and which they can be left as point estimates. So we're moving now to prioritization. So if a company makes everything top priority, they're actually not prioritizing anything. Nothing is top priority. So prioritization is clearly important. I like to think about prioritization in its simplest form as sorting by desirability. So what's that measure of desirability? Well, it can be goodness, or it can be a ratio of total value to remaining costs, sometimes called productivity. So that productivity is going to be the score or the risk-adjusted or expected net present value over the remaining cost to launch. So we're not considering sunk costs here. So let's take a look at an example of that here. So we can look, for example, at goodness, and we can sort by the highest ENPV projects, or we can bring in a non-risk adjusted NPV, or we can bring in a peak sales value. And we can look at those, sort by those, but we don't have a sense of is it affordable or not with respect to our cost to launch. And this is where we need to bring in a productivity metric. So here we're going to look at ENPV over cost to launch. And we're going to plot this with respect to ENPV on the y-axis and current year cost on the x-axis. So now we're accumulating these, so each project is incrementally adding their value, which moves them on the y-axis, and their cost, which moves them on the x-axis. So you can see this first set of projects are very low cost. They're not moving us much to the right, but they're high value. They're moving us up. And then as we descend that productivity metric of value over cost, we can see subsequent projects are moving us further to the right and not so far up until this line actually levels off. So it's easy to say here, let's look at our $100 million budget for the current year cost and say that let's fund this set of 9 or 10 most productive projects. But to do that, we'd be missing out on something important. So prioritization is about, and portfolio management is about picking the best set of projects, not the best individual projects. So that ranking by desirability is a good first step, but it doesn't think about other critical metrics. The best set of projects are going to meet portfolio objectives, not just a single value criteria. So let's talk about objectives. I see an objective as a combination of a target and a bucket. That target might be revenue or revenue growth or R&D spend, and the buckets are where that is taking place. So we're looking for revenue growth within a therapeutic area or within a region or by technology platform or franchise, or we're looking at it in the short term versus the long term. So when you take a target and a bucket together, that's when you have an objective. And that's when you can begin to think about not just your ranking, as you see here on the right, but also you can begin to think about your therapeutic area balance and your balance of early versus late stage projects. So we can see here, if I decide to fund all of those projects, basically turning them orange here, that are less than $100 million of current year cost, we'll see what we've done to the portfolio here. So you can see here I have just $71.5 million in current year cost. And if I fund the next project, I've broken the budget. But I can fund the next one, get us exactly to $100 million. And what have I done to the balance in our portfolio across some of our other objectives? Well, you can see that I've defunded most of our CNS portfolio and all of our immunology portfolio. And I've defunded all of our phase 1 opportunities and our phase 2 opportunities. So clearly, I haven't balanced the portfolio. So here I can begin to think about pulling in an assessment by phase, and I can sort by that productivity ratio and then look by phase, and you can see that for preclinical, I haven't brought in any of my most productive projects, nor for phase 1, so I'll bring in some of those highest productivity ratio projects, and the same for phase 2. Now when I go back to my layout view here, you can see some of these projects have come in, but I've more than doubled our current year cost. Now it's time to go back to R&D and to the executive teams and look at whether we can justify this additional spending. That kind of trade-off analysis is a good way to catalyze change in an organization and to change what you're spending your money on, because it shows exactly where you're spending your money and how it might be misaligned. Another way to do that is with a Pareto view. And so the Pareto view I'm going to show you here is going to look at peak year sales on the y-axis. And on the x-axis, we're going to just look at our projects. We're going to sort this by peak year sales. We're going to add a Pareto line, and we're going to put this at the 80% level. So what we've done here is this line is showing us 80% of the value is subsumed by the projects here on the left. And yet this set of projects on the left that represents 80% of the value is only about 20% to 25% of the total project set. So that means that there is 75 to 80% of the projects that hold just 20% of the value. So this is death by 1,000 cuts. 80% of the value is sitting with just 20% of the projects. The questions you need to ask yourself at this point are those higher value projects suffering from a lack of attention? And that might be specific skill sets or staff classes or dollars, but it could also be just a lack of focus because there are so many other projects in the portfolio competing for focus and attention. And if so, can you reallocate funds to give the highest value projects a chance? Okay, moving now to risk management views. So risk management and understanding uncertainty requires simulation at both the asset and portfolio levels. So you can answer the question, how might the entire portfolio fare? A set of metrics are given here. We're going to go through these in more detail. And it's important that there's mutual agreement between your team and the executives before you start showing these in reviews. Make sure they understand the metrics and they understand the value and they buy into the value. Don't surprise them with these kinds of analyses on the day of the portfolio review. So the simplest view perhaps is looking at E, or expected net present value, also known as risk-adjusted net present value. Looking at this compared to the unadjusted or given success net present value for each of your assets, or for the TAs as a whole, or for the company as a whole, as you see here in the bottom total line. So you can see an unadjusted NPV of $22 billion versus a risk-adjusted NPV of about $9 billion here. You can also look at that risk-adjusted net present value, not just at the mean value, the expected value, but you can look at a histogram of all of the possible values across all of the possible futures that your Monte Carlo simulation has created. Also, you can look at the expected launches per year based on the probability of projects launching in each year based on their phase transition probabilities. And a second way to view that is in a pipeline view, where we can color here by phase and look at a potential pipeline. And let's in fact make this a little easier to see those that are still under development. And now we can take this one step further, instead of just looking at the progression by phase over time, and look at a risk diversion. And now we can see the number of projects in the pipeline or successfully launched into the market on a risk-adjusted basis. Views here, expected versus potential revenue for the portfolio versus a target, where potential revenue is going to assume success. Expected revenue will look at success as uncertain. And then simulated portfolio revenue for the entire portfolio with probability bands. So here we're looking at an 80% confidence interval. So we're 80% sure the value in any given year will be between the upper blue and the lower green line, with the median being the orange line. But it's more useful when we're looking at a target across this. And so with that target revenue there, we can say that in 2020, the middle of 2020, we have a 90% chance of meeting our target, only a 10% chance of the value being lower than the target. But in 2025, we only have a 10% chance of meeting our target because we've hit that 90% probability band. All right, moving on to portfolio reviews. So portfolio review season is a very trying and stressful and chaotic time. You're trying to nail down every project's true valuation with the latest information, and it's a moving target. And I wanted to underscore just how chaotic this can be by looking at statistics from our system in terms of activity in a 2-month period right around a portfolio review. So you can see here we have logins, project loads, and portfolio loads. And for the first several weeks, you see activity during each day, with the weekends being fairly clear. But as you run up to the portfolio review itself, you see activity is 24/7. And this translates into thousands of logins, multiple thousands of project opens, tens of thousands of project changes, and thousands of portfolio views as well. So there are clearly a lot of moving parts and a lot in play. So in the context of this dynamism, how can we avoid garbage in, garbage out? How can we assess the portfolio in the larger light of strategy? And how can we retain our executives' confidence in the process so they don't simply shoot from the hip and make decisions based on their gut, rather than the collective wisdom that you're trying to present to them? Lesson learned is consistent data structures. With this many changes coming through the pipe, it's important that project names have a very strict naming scheme, and that everyone understands that that naming scheme has to be used both for projects and scenarios for those projects, and that value is always comparably presented, as well as costs, and the specific milestones that are used need to be defined unambiguously as well. again, with tens of thousands of project changes, if these aren't consistent, you're going to be drowning in a deluge of inconsistent information that you need to make heroic assumptions to synthesize. There needs to be consensus on the review scope too, thinking about which projects are in scope and out of scope, which therapeutic areas, which phases, partnered projects versus internal projects, and what is the available budget for this upcoming review period. And there needs to be strict accountability for every piece of information and a chain of command through which that information flows to the portfolio team and eventually to the executives. There shouldn't be backdoors, and there should be an approval process in the stream. There should be a lockdown date so you can avoid the chaos in the week and a half before the portfolio review that we saw on that last ticker tape. And you might consider meeting first in advance of the portfolio review to bless each project's details and get sign-off with therapeutic area heads or your R&D heads. And then have multiple meetings to refine the portfolio investment plan once that was in place. With all of these moving parts, an operation room where everyone can be in the room every day in the run-up to the portfolio review is a great idea. Electronic tools are wonderful, but you need to be face-to-face to make tough calls every 10 minutes. And then unified storage. So that might be an online system like the Enrich Analytics platform, but it could be as simple as a Google spreadsheet to track the information, allow people to collaborate, and have you not be the bottleneck for compiling that information. So let's talk about the portfolio review itself. We're all wired to connect to stories, not to data or charts. And a story in 3 acts also seems like part of our species' DNA as we sat around campfires in time immemorial. So let's look at the 3 acts of where we've been, where we are, and where we're headed. These 3 acts will get everyone on the same page, appreciate what's been accomplished, get them ready for the challenges to come, and hard decisions ahead. So your portfolio review should, in some form, contain these 3 components to be effective. Where we've been, Act 1. So do you remember the 1993 film Groundhog Day? Bill Murray's character, he kept living the same day over and over, and he was doing crazier and crazier things to try to break the cycle. What does this have to do with portfolio management? Well, I think that executives feel like this sometimes in portfolio reviews, where an unsettlingly familiar sort of chaos ensues from the first slide. Fundamental disconnects and expectations are revealed when executives ask what they think is a simple question, and the portfolio team goes into a tailspin. They feel like they've been there before. So the key here is to avoid Groundhog Day with keen preparation. The first piece is to level set and establish continuity. So get consensus through pre-briefs with the executives on the meeting objectives, the roles, and criteria for success and failure of this portfolio review, and consensus on what would constitute a true success and what each person's role is in the process to ensure that success. Consensus needs to be made on the materials, too, that are going to be used. Then you can ask, what did we set out to do? What were the major decisions of the last meeting and review cycle? What were the challenges we faced? And then, what happened? Did we succeed? What is the currently available budget that we have to work with? And what's the current set of ongoing projects? What's the status of those projects? So that's a perfect lead-in to the challenge of the day. What needs to be done today and what will constitute success? So Act 2, where we are. You'd like this in the portfolio review to be a strategic activity, but you're going to dive down into the projects as well. Executives are going to do that to pressure test reality and to build confidence, but also those project details matter. And sometimes operational project details matter as well. So let's take a look at this in the Enrich Analytics platform. We might begin with this kind of a view, looking at the overview of the portfolio and understanding where we're spending our money from the perspective of each therapeutic area, and then drilling down into these therapeutic areas, and then getting a sense of what's going on within each of the projects within this therapeutic area. And being able to look not only at probabilities of success or the milestones, but also the costs and revenue over time. And being able to look at perhaps a full profit and loss statement, but also information on that revenue story. And here's an example of the target product profile, looking at how our product compares across critical dimensions versus the current standard of care and the emerging standard of care that we think will be there when our product launches. So all of this information needs to be available so that executives can have the conversation in real time and do so without having you resort to 150 PowerPoint slides, most of them being backup. So the ability to look at these views both for any given project, but also for an entire therapeutic area, and consolidate that information, or for the portfolio as a whole, is essential in real time. You may be looking at the portfolio as well in more of a graphical view. So for this, you might look at what we might call an innovation landscape, looking at those projects that are funded within each of the therapeutic areas. We can look at this by strategic fit or schedule status, and we can begin to annotate this so that you don't need to hover over every project or drill down to get additional information. There may be views that are critical by therapeutic area in terms of cost or value as well. So looking at, say, ENPV by therapeutic area, and then looking by phase here, getting a sense of overall costs, where we're spending our money by phase and by TA, and being able then to drill down equally quickly and look at the specific projects or the consolidated financial statement for each of these, but then being able to go right back to the overall view of the portfolio that you were looking at before you drill down again. So that's where we are. Now let's talk a little bit about variance analysis. When I thought about variance analysis, I thought about this particular album cover, and then I took a step back and realized that David Bowie himself was really a poster child for variance analysis, because he helps us see that it's not enough to look at one David Bowie album or one David Bowie look. You need to look at the entire career. You need to look at where we've been to understand where David Bowie ended up and who he really was. And the same is the case for portfolio management. That portfolio management is only as good as your executive's confidence in the information. And that confidence is going to be a function of their confidence in the valuations. And so they need to understand not just where we are today, but how we got here. And so looking at, in this case, the revenue variance here over time and seeing it's just a handful of projects that, since the last portfolio review, have resulted in a revenue change is important. And similarly, looking at, say, the ENPV variance. So let's bring that ENPV variance next to the NPV. And now we can sort this in terms of the ENPV change and not just the current ENPV for each of these projects. And we can look at this by therapeutic area, look at the variance by therapeutic area, drill down into a specific therapeutic area, and then drill down into a specific project that had high variance. And now we're looking at some of the views we looked at just a few minutes ago, but we have a knowledge of changes in probabilities of success and resulting changes in where we thought this product was for revenue. It was a $500 million a year peak sales product 2 years ago. Now we're looking at maybe a $300 million peak year sales product. And that's a function of a change in revenue, which translates directly into a change in cash, which translates into a change in NPV. So that kind of variance analysis is good at the project or therapeutic area level, but you can also look at variance at the portfolio level, and here we're looking by therapeutic area at a waterfall, where we started with, let me make this ENPV. We started with a $6 billion portfolio, and we've moved to, 2 years later, a $9 billion portfolio. there was a drop of one project, there was a reduction in value for eaglogen, which we just saw based on probabilities of success, and there's been an increase in quite a few other projects across all 5 therapeutic areas, and there's been one project that's been added, resulting in the value that we see today. And of course, to be able to drill down at any point here and have a conversation about what's going on with that project and what's changed is critical. Okay, now we're at Act 3, where we're headed. So I put this image up because the best way to invite change is to make the present course completely unpalatable. So where will this portfolio get us? Will it meet our targets, and how likely is it? So scenario analysis is a perfect way here to suggest the value of the present course and to present alternatives. I'll give you one example here on where we're headed. The company we recently worked with, this was a high technology company who announced a Win 2020 strategy, and they said they were going to have 110% revenue increase within just 4 years, so a 20% compounded annual growth rate, which is amazing considering their growth had been flat. So how were they going to do this? Well, we drilled down further with this company and saw that they had 3 priorities across 12 product areas. They were defending their current product line, they were preparing for new contracts, and they were growing in new areas. So what we did with them was build an innovation landscape. And I'll show you what that innovation landscape looks like here. First, unpopulated. So here are the priorities: prepare for current contracts, defend existing areas, and then we separated out, grow in existing areas versus grow in new. And then we had the product areas here that we identified for those now 4 areas. And when we look at their portfolio, here's what we saw. So dark blue bubbles are breakthrough projects, light blue are incremental innovation projects. And you can see the bulk of their spending is in defend existing areas. And if we look at totals here, it represents $9.4 million in spending versus $7.1 in grow, and not much anywhere else there. So the challenge is they were currently making all their money for offering 3 or selling offering 3. And so all of their projects are defending offering 3. That's where all of their attention and energy was going. But when you look at what they're doing to grow in new areas, there's almost nothing there. And growing in existing, where there's some opportunity, but not a lot, again, there's very little on the docket to grow in the areas where there's highest growth. So this was a way of demonstrating to the executives we are not aligned with this strategy, and it created the opportunity to talk about change. Now let's look a little bit further at the ability to not only paint a picture from that innovation landscape perspective, but also looking at the actual revenue that you might have for a given portfolio. So here we're going to be looking at a portfolio, and we're comparing it directly to the revenue target. So we have potential or revenue given success, and you can see we're meeting our revenue target handily. However, we need to look at risk-adjusted revenue. And now we see that we're actually coming up short in the outer years of this time horizon. So now we can add a series of placeholder projects to this portfolio and build up a scenario of a series of in-licensing opportunities that we take advantage of. And we'll just have 7 of them here, 7 deals that we do in 2017 in CNS. And now when we go back to the portfolio view, you can see the revenue for those PH or placeholder projects coming in and getting us much closer to that overall revenue target that we'd set for ourselves, even on a risk-adjusted basis. Similarly, we can compare multiple investment strategies. So here we have not just one base case strategy, but several other strategies as well. And those strategies may include maybe buy up or accelerated development scenarios for some of our projects. So we can see for each of those portfolios that are defined, we have a separate cost to launch and a separate peak sales, separate ENPV estimate. So the least affordable but most valuable is the all-in portfolio. We have several others here. Now, none of these are actually coming 100% through to meet our expected revenue target, which is the blue wedge here, but the all-in portfolio comes closest. However, none of these are meeting our our cost constraints that we have. So now it's important to come in and, for some of these, remove a few of the projects to get us closer to that cost constraint, and then to look at the implications for where we sit on our revenue versus our revenue target. So optimization can also be used. And I can leave that for another demonstration, or you can reach out to me if you'd like to see that later. But this kind of tuning the portfolio by hand and looking at multiple investment strategies is a very good way to think about where we're headed and where we could be headed if we change our spending strategies. So I wanted to round things up here by talking about a frequent concern companies have. Boy, that looks great. The way you've laid that out at Enrich with your tools is amazing, but we don't have enough data. Well, if you think that you don't have enough data, let's look at the simplest pieces of information that are important here. For a list of initiatives and strategic arenas, or at least classifying information, you can begin by building the innovation landscape I showed you here. You can also, with cost information, now build a cost-based Pareto if you're looking at the current year costs or the cost to launch. And with value information, you can build that frontier that we looked at, as well as a value-based Pareto. And it's important to understand that the level of sophistication of your value forecast is subjective. And what's appropriate for you may not be appropriate for another company with another type of portfolio. Just a word about our offerings. You've been looking at a lot of our reporting capabilities here today, and those are available both in our full-fledged platform as well as in Viewport. The Enrich Analytics platform adds project scoring, evaluation within the tool as opposed to in your own Excel spreadsheets, as well as resource planning and scenario analysis and data exchange with other applications at your company. These tools are best in class not only because of the capabilities and the visualization power, but also because we can get you up and running with Viewport, for example, in less than a day. And the Enrich Analytics platform is similarly nimble in providing enterprise-class portfolio management. Well, I hope you've enjoyed this tour of best practices in portfolio management, and I hope you have something you can take back to your organization. You can see that at Enrich, we're passionate about portfolio, and I know all of you are too. And I look forward to continuing the conversation with you with any comments you might have. Thanks for your time today.
Thank you very much, Dr. Sonnenblick. We do have some questions. There is still time if you have questions to chat those in using the chat panel, which you'll find on the green tab in the top center part of your screen. Our first question, we'd love to perform a more rigorous portfolio review, but we're just getting started. What information is needed for the simplest possible portfolio review?
That's a great question, and that is the right place to start. Look at the data you're capturing today, and if you are performing project-based budgeting, so you have a discrete cost for each of your activities or each of your assets, and you have some sense of the revenue story for each of those assets, you can perform a basic portfolio review. And the most important aha moments that you might get in that review are the number of projects that are nowhere near strategy or that you thought had already been canceled, your executives thought had already been canceled, but seem to still be funded, or the redundancy in your portfolio, looking at projects that are overlapping or even simple duplicates that the organization wasn't aware multiple projects were being worked on in that domain. So that's the first step. And moving beyond that to more sophisticated financial measures, and more detailed information about how the revenue or opportunity is being built up would be where you go from there. But it is most important to start with the data you have and review it with the executives and let them create an appetite for more sophisticated data collection.
All right. Our next question, when should we use prioritization and when should we use optimization?
That's a good question as well. Prioritization is fine when you do not have a lot of dependencies between your projects, such as lead and follow-on indications, and when you do not have many buy-up and buy-down options for your different assets, different projects. When you do have those dependencies, or when you do have buy-up and buy-down options for your projects, optimization is going to do a better job than simple prioritization of ensuring that the full space of different possible investment plans is being tried so that you have the result being one that is truly optimal. Now, the important caveat here is that optimal, in quotes, investment plan may or may not be politically palatable. And so there's a need to take that investment plan and maybe fine-tune it, which will make it less optimal in a mathematical sense, but much more appropriate in a holistic sense.
All right. How can we improve data quality in our asset valuations? Well,
people often worry about garbage in, garbage out, and it's a real concern. The challenge is that the number of inputs across the portfolio for all of the assets and the diversity of where those inputs come from make it a real challenge to ensure that there's quality across all of those different pieces of information. I think the best opportunity is to create a process where the portfolio review goes through several different levels. Projects are reviewed by program leads, and those program leads sign off on the project value, and then therapeutic area or division heads sign off on the program forecasts and the program value, and that chain is unbroken and always used so that when you get to the executive level, all of the executives know that any project that they're looking at has passed several levels of sanity testing and accountability. And it's that accountability that really makes the difference.
All right, perfect. Another question, does the Enrich platform have forecasting, such as UUSD and units capabilities, suited for generic pharmaceuticals?
We do have a generic module which allows companies to forecast across hundreds or even thousands of SKUs, looking at historical data and then modifying the forecast as a function of some parametric analysis based on the historical data.
Checking down through our chat panel here, that does appear to be our last question. I do want to thank you again, Dr. Sonnenblick, for your wonderful presentation. I'd like to thank Enrich for sponsoring today's web symposium. And most of all, I'd like to thank those of you who came and spent some time with us today. I hope you found the webinar interesting and insightful, and you found some answers to your portfolio questions. So with that, I'll say thank you all so very much, and have a great day.